Ladies and gentlemen, boys and girls, welcome to FinFluential Media. We have quite the show today, a lot of volatility. What a mess this week has been, but we're going to talk about it. We're going to talk about the market, what happened today, what were the winners and what were the losers. We're going to talk about tariffs and how it pertains to you as a consumer, the economy, and what it means for some of your most loved stocks like Tesla. And we're also going to look at some of the price increases or decreases that could come from tariffs and some of the early updates we're getting as it pertains to some auto manufacturers. We're also going to talk about Nvidia, CoreWeave, Lululemon, and then we're going to look at a stock that's on my watch list that I may buy in the future. Now, before we dive in, guys, if you could please go ahead, like this video, subscribe, hit that notification bell. I would greatly appreciate it. Let's dive in now. Looking at the market, guys. Look, there were winners today, there were losers. That's just how the market goes. But the biggest losers here was definitely software and IT services, technology, equipment, hardware, semiconductors, Nvidia inside this sector right here. And then financials, banking down 0.64%. But there definitely were some winners. Telecoms, right? Insurance, consumer goods, food and beverages, retailers, healthcare as well. Very defensive sectors leading the charge today. And you could see we saw a rotation out of highly cyclical, highly growth names like Robinhood and Nvidia into more defensive names. Apple is considered a defensive tech stock. Apple was up 1% today. Look at AT&T up 1.99%. It's a telecom. That's a defensive name. And we also saw movement out of stuff like financials. JP Morgan down 1.16% today. Gold hit another record high. Economic uncertainty is driving demand for safe havens, guys. That is why we're seeing gold at above $3,000 an ounce. Absolutely insane. And expect this to continue the more uncertainty we have in the market. As autos were down. Now, Tesla actually gained up 0.32%. At one point, it was up as much as 6%. BYD and Ferrari also bucking the trend. Ferrari has immense pricing power. That's what they were up. No idea why BYD was up nearly 4%, but the market obviously assessing the fact that the tariffs may not impact BYD as much as anticipated. Volkswagen was up 0.18%. Rivian was up 7.6%, and all of the other providers were down in a very big way. And I expect selling to continue in these names, but a lot of them also trade at pretty reasonable valuations, mid-single digit PEs. So, they're not going to completely have double-digit losses per se, but it is a challenging environment for them nonetheless. Now, the reason why we have Tesla, BYD, Ferrari, and Volkswagen outperform today is because they have the least exposure to Trump's tariffs. Look at Tesla. 100% of a Tesla vehicle is manufactured in the US. And in fact, only 1.8% of a Tesla that is sold in the US is actually from imported parts. And I'm assuming these parts are from Canada or Mexico. So there will virtually be a zero tariff on these parts right here. However, when you look at some of the other Asian names, stuff like Toyota, stuff like Hyundai, GM, Nissan, Stellantis, right? A lot of the car is manufactured in other countries and they have a lot of important parts from other countries. And so these companies are going to be materially impacted by a 25% tariff. BMW came out and said this is what their price increases will be. Looking at an M2, it normally goes for $65,500. The new retail price on the 1st of May will be $68,200. That's a $2,700 increase. And it does look like BMW are going to be absorbing the majority of the cost. Just for the record, right? Almost 100% of BMWs are not made in the US and they're almost 100% international parts. So, a BMW could be getting the full amount of the tariff. And to see the price only increase $2,700, BMW is going to be absorbing most of that cost. So, their top line may actually increase ever so slightly, but their margin, their bottom line, their net margin, their free cash flow margin, their EBITDA margin is going to suffer significantly because of Trump's tariffs. We'll see how their pricing evolves as we get to the 1st of May. I'm assuming they're going to layer their price increases as we go. But Trump's tariffs are officially here and we are feeling it, guys. Very interesting times we live in. Now, let's actually talk about Nvidia. Now, CoreWeave is set to IPO at $40 a share, I believe, tomorrow. They were supposed to IPO and raise $2.7 billion. That deal size has actually decreased to $1.5 billion. This is not what you want to see if you're a tech investor, if you're an AI investor. Seeing that just screams a red flag. It probably means a huge investor probably pulled out of the IPO or multiple did based on a number of red flags. Now, we don't actually have any reason as to why it was lowered. What we do know is that Nvidia will be backstopping or anchoring CoreWeave's IPO at $40 a share. So if CoreWeave gets to $40 or below, that is where you probably want to load up, especially for a short-term trade. But I think the biggest reason why we actually saw this deal size lowered had to do with CoreWeave's financial health. Now, despite impressive revenue growth, CoreWeave saw $1.92 billion in revenue in 2024. That's an 8x from 2023. The company reported a substantial net loss of $860 million in 2024, $593 million the year before. And this persistent unprofitability, coupled with a heavy reliance on debt, could have spooked investors. There's also a ton of financial engineering in its books with its adjusted figures versus its GAAP figures. Also, 62% of CoreWeave's revenue comes from Microsoft. And so I think all of these factors contributed to their deal size getting smaller. Nonetheless, they're still going to be getting $1.5 billion out of this IPO. They can pay down a substantial amount of their debt, potentially expand if they believe the AI trade is still there. Yeah, this is not what you want to see when it comes to AI and tech stocks, but this could be something that passes. Maybe CoreWeave themselves actually wanted to lower the deal size. Maybe they wanted to sell less shares. Something else I did hear the grapevine, and I'm not too sure about it. The founders of CoreWeave are selling $500 million worth of stock in this IPO. So that's also a little bit of a red flag. But guys, I will keep you updated with how the CoreWeave IPO pans out. Nonetheless, I'm excited to finally see some big names come into the market. And this might be the biggest IPO of the year, excluding maybe Stripe or like if SpaceX goes public. Now, Lululemon reported earnings today. Now, the stock had a great quarter, but guidance disappointed. The CEO says the consumer is cautious. Now Lululemon outperformed expectations for Q4 with revenues growing 13% to $3.6 billion and EPS reporting $6.14 from $5.29 in the same quarter a year ago. This beat estimates of $3.58 billion and $5.88 respectively. So the quarter beat in a very big way. The problem is guidance. For the first quarter of fiscal 2025, Lululemon expects earnings per share in the range of $2.53 to $2.58, missing the street's expectations of $2.74. The company guided revenue in the range of $2.3 to $2.35 billion, representing growth of 6 to 7%, well below the estimates of $2.4 billion. So Lululemon was down 10% here in the after hours, up 1% on the day. In the last year, Lululemon was up 11.5%. And let's go ahead and have a look if it's a buy now. We're looking at a 24 times PE ratio, 22 times forward. And if we go to analyst estimates, do we have some buy ratings here? Let's have a look. 26th of March. So we haven't gotten the updated buy ratings, but as of today, we're looking at 7 buy ratings, 7 strong buy ratings, 11 buy ratings, 8 holds, 1 sell. And then here are the quarterly projections for Lululemon. So you could see that looking at double-digit growth, but that is tempering off. I mean, if we actually go to the financials, I think part of the reason why the stock hasn't done so well in the last year, because if you look at the growth, right, 18%, 29%, 42% in the last 3 years, that's actually decreased to just 10% on the year. So we're seeing decelerating revenue, and the market doesn't really like to see that. Nonetheless, this is a pretty high quality company. I was looking at some of its efficiency ratios. And look, return on invested capital, return on capital employed, very, very strong. And an earnings yield of 4%, free cash flow yield of 3.85%. I still think the stock is a little bit expensive. For me, it's not a buy right now. I think at $250 a share, the stock might actually look quite attractive. Now, let's move on, guys. Let's actually talk about a stock I've been doing a lot of research into. I don't hold, but a business that I think is relatively interesting, and they're called InPost, ticker symbol INPST. They also have an ADR on the US market with the ticker symbol INPOY. Now, just to give you guys an outline of what InPost does, together with its subsidiaries, it operates as an out-of-home e-commerce enablement platform providing parcel locker services in Europe. Now, it operates through 4 segments: APM, two-door, Mondale Relay, and international/other. The APM segment focuses on delivery of parcels to APM, so to these parcel lockers, and operates pickup drop-off points in France, Spain, Belgium, Netherlands, Luxembourg, and Portugal. There's no US exposure. It's just in Europe. The international other segment delivers parcels to APM and pickup drop-off points in the United Kingdom and Italy. The company also provides fulfillment services, marketing and IT services, in-post pay services, and a platform for fast-moving consumer goods through the InPost Fresh app. It was founded in 19. It operates as a much more modern form of like DHL. It focuses more on deliveries to parcel lockers, to their parcel lockers. It's a closed system, and the benefits of it quite substantial. Now, the most expensive part of delivery when you order something on like Amazon, the most expensive part is the last mile. That last mile of delivery accounts for about half of the cost. So if you could just wipe out that last mile, right, getting the parcel to your door, you essentially can cut the cost of shipping essentially in half, right? And how you do that is with parcel lockers. Now the benefits of a parcel locker is that there's no need to queue. It's got 24/7 availability, pick up, drop off in less than 30 seconds. You can actually do returns and pickups through these lockers. They're placed in very convenient locations, and there can be multiple parcels in the same locker. They also have a mobile app, so you can open the parcel locker through this thing right here, or just through your mobile app, and then the individual locker can open. It's very, very convenient. Now, InPost operate in 9 markets. They have 43,000 parcel lockers and 34,000 pick-up drop-off points. Now, they are based in Poland, and they saw 15% growth. This is for Q3 year over year. Parcel volume was up 21%. On the international segment, they're seeing even greater growth, 66% growth here in the international segment, 87% APM volume. And you can see they are taking market share from the leader, Amazon. Amazon actually decreased their parcel lockers because they signed a deal with InPost, I believe, in the UK and a bunch of other countries. And we have seen InPost increase their parcel volumes in certain countries. This isn't Poland, I believe this is the UK, but this trend is prevalent in all of the countries they operate. They're taking market share from the leaders and account for 50% of total parcel volume in Poland. Now, I know when you look at a parcel locker, you can say, hey, why don't like anybody can do this? They have no moat. And I wrote up a 34-page report, and this is a section from the report, right? I'm going to read it to you. And this is regards to their moat. So this is one part of their moat. I'm just going to read the entire thing to you. Now, scale economies here, or for InPost, are similar to those of many logistic operators and derive from high fixed costs of running a multi-nodal distribution network. To be competitive, a network has to have sufficiently high pickup and drop-off density that is convenient for both consumers and merchants, as well as economical to operate. In order to achieve this, a network must have a lot of volume, which presents a chicken and egg problem. You can't persuade merchants to send volume your way if you don't have the scale to distribute them efficiently and the ability to demonstrate customer acceptance of your offering, which can only be done with the volume and a track record which requires merchant acceptance. If an entrant is somehow able to attract the necessary volumes, then it has the daunting task of distributing them economically. Revenue per parcel is low. InPost averages about 2.1 euros in Poland, and profitability distributing these parcels requires huge volumes and extreme levels of efficiency so that the marginal cost of distributing each incremental parcel becomes negligible. To have the capability to do this, vast sums need to be spent on equipment, people, and infrastructure, and huge sums are also needed to fund losses across the network as it scales up, presenting yet another hurdle. All in all, with these challenges in mind, it's no surprise that the parcel distribution industry has very high barriers to entry and tends to be highly consolidated, with most markets having just 2 to 3 scaled players. Now, it is trading on a little bit of a rich valuation. You can see a 30 times PE ratio, 20 times forward, so they are growing quite significantly. You can see that the company, now this is in PLN, so this is the Polish dollars. They did about $10 billion in revenue. You can see very, very robust growth. This is expected to continue. If we actually go down to their margins, you could see an 84% gross margin, 18% operating margin, 14% free cash flow margin. Looking at the company's balance sheet, they have 781 million in cash and cash equivalents. And then if we actually go down to their total debt, they have 7.1 billion in total debt. So they do have quite a lot of debt, but they are expanding quite significantly. Looking at their efficiency ratios, you can see here that they trade on an EV to free cash flow ratio of 25 times. So not egregious, 20 times EV to EBIT. And then look at their return on invested capital, 13%, 63% return on equity, 11% return on assets, 20% return on capital employed, a 3% earnings yield, and a 4.8% free cash flow yield. So this does look attractive, but it looks even more so attractive when you actually look at the growth prospects of the company. Now, I've modeled the slightly below consensus. Consensus is expecting 15% growth from 2024 all the way to 2029, I've inputted 13% and no margin expansion, right? The consensus for margins in 2029 is about 25%. We're just going to use 14%, right? So if you model that out with the free cash flow margin, you get free cash flow of 690 million euros at the end of 2029. Using an EV to free cash flow of 15, right? So we're seeing some multiple contraction. You get that as an enterprise value, subtract the net debt to get the equity value, divide by shares outstanding, and we're not going to see an increase or decrease in shares outstanding. Stock price at the end of 2029 should be $17. Now, this is on the ADR, by the way, guys. The current stock price is $7.83. That would represent a 17% compounded annual growth rate over the next 5 years. On extremely conservative estimates, I think you could see up to $1 billion in free cash flow in 2029, assuming everything goes perfectly without any hiccups. Now, the reason why you build a margin of safety into your model is because there's always going to be hiccups. But to see the multiple contract this much from 24 times to 15 times really goes to show that this is a solid company trading at a pretty huge discount, growing significantly, and they are the leader in Poland. They're growing so quickly in the UK. They have strong presence in France. I believe they're the number one player in France as well. They're taking market share from the very, very big players, and they're not exposed to any type of US tariffs. They want to keep it in the pan-European basin. We do know that European stocks are set to do very, very well. Earnings are getting revised to the upside. So is GDP estimates, because European countries are doing a ton of stimulus, and we know the central bank's cutting there as well. So this is a great stock. So I've got a ton of research. I got a ton more research to do into it. But guys, over the weekend, I'm going to be posting on my Twitter the full 34-page report. I have it on a Word document. I just got to format it. Once I have it formatted, I'm going to be posting it. So you guys will have it first here. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, and leave a comment for the algorithm. Cheers.